Alrighty, Bertha, we're going to talk more about the Dow being in record territory. And how about the S&P 500? Is that finally going to follow? Frederick Dixon is with D.A. Davidson. He says the S&P 500 will likely hit new record highs in the first half of 2007. Peter Schiff is with Euro Pacific Capital. He says it's unlikely that the S&P is headed for new highs anytime soon. And he says, besides, these records are meaningless. How's that to rain in the parade? All righty, Peter, we're going to get to you in a second. Fred, go ahead. Make the case for the S&P 500 following the Dow into record territory.
Oh, good morning, Michelle. What we see is a very strong global economy driving expectations, good strength in the U.S. economy. Unlike Floyd Norris, who was a guest on a few minutes ago, we're a lot more bullish about the overall economy, mainly because of the shift to the service side and service sectors. S&P is being driven at this point by strength in the technology area, and I think we also see strength in the industrial side of it. I don't think people realize that the S&P is already up about 60% this cycle versus 50% in the Dow. So we got some good momentum going, and we're getting some good third quarter numbers.
Peter, what's not to like?
Well, first of all, the nominal new high in the Dow is an illusion created by inflation. In order for the Dow to have the same purchasing power it did in January of 2000, even if you accept the government's version of inflation, the CPI, we need to be about 14,000 right now. If you assume, like I do, that the CPI is understating inflation by 2 or 3 percentage points a year, now you're talking 16,000. You know, if you price...
Okay, but we have to crawl before we can walk, right? I mean, first we got to get to 12,000 before we get to 14,000.
I don't think we're going to make an inflation-adjusted high in the S&P over the next few decades. I don't think the NASDAQ is going to make an inflation-adjusted high in our lifetimes. You know, the market was extremely overvalued at that point in time, and we have a lot of inflation. You know, and if you look at the Dow in terms of other currencies, the Dow is still off about 33% in terms of euros. It's off about 25% in British pounds, in Canadian and Australian dollars. It's off 50% in terms of gold.
So it's not going to make an inflation-adjusted high, but that doesn't exclude it making a nominal high for the S&P 500, which would be a good start.
Well, I don't think it's going to be difficult because I do think we're going to be in a recession next year. I disagree that the U.S. has a strong economy. I think we have a fundamentally weak economy. You know, you don't borrow and consume your way to prosperity. You borrow and consume your way to poverty. And unfortunately, that's what we've been doing, and that's where we're headed.
Peter? Fred?
Well, let me just come back with a couple points. The first one is that, yes, we have borrowed our way to some economic growth. I think that investors don't realize that at this point, there's about $2.2 trillion sitting in money market funds, about another $8 trillion in CDs and time deposits, savings deposits. If you add the cash together, there's still a lot of cash out there, and that needs to be netted against some of those borrowing levels. I think we're talking in terms of nominal movement in the market averages, and those nominal moves are what really drive investor expectations to go higher and think about what is happening. And our sense is that we'll see some market behavior response to the new record in the Dow caused by investors needing, particularly hedge funds, needing to cover shorts and under-invested portfolio managers needing to play catch-up. So
now, all these nominal moves, though, is confuse investors into believing they're getting richer as they're actually getting poorer. What really counts is what the Dow is worth relative to the cost of living. You know, and as far as borrowing our way to some economic growth, we're not really having economic growth. 70% of GDP is consumption, and what we're measuring is consumption. I mean, Michelle, think about it this way. What about a family that, if I told you there was a family that maxed out its credit cards, that took out a second and third loan against its house, that rated its kid's college fund and borrowed against its retirement account, would you think that that family was doing well? You know, contrast that to another family that paid off their credit card debt, paid off their mortgages, fully funded their retirement accounts, and had prepaid their kids' college education. You know, you save your way to prosperity. You don't borrow money from foreigners to buy imported products that you can't afford and run up a massive debt and pretend that it's economic growth.
Fred, you get the last word here. 10 seconds because we're running out of time.
Okay, well, as we talk to our retail clients out on the West Coast, a lot of them have a lot of cash, so they're very comfortable in the economy, and they feel very good about their lifestyle.
So there. All right.
But wait till their house price drops.
And then we will have you back for that discussion as well, because it's certainly one of the concerns in the economy right now. Gentlemen, it was very interesting. Thanks for weighing in.
Thanks for having me.
Thanks, Michelle.